maybe your name, your title, your company you work for, your startup. Could also be your LinkedIn profile, any information you want, please, about yourself, so other people in the group can get to know you. Yeah, Marino, Fagianato, okay, you can hear me as well, that's great. Excellent. So what this is, I'll make a start and then people can join us. This seminar is on financial forecasting and modeling. What this means, you can take any company and at any stage and almost give it a profile or model on a spreadsheet of what it would look like in terms of its income and expenditure. Doesn't matter what stage, what type of company, how complicated, how simple it is. This idea of putting everything on a spreadsheet is very important, especially if you're trying to look for investment. So if you go to a banker, they would like to see this information. If you go to a VC, they would love to see this information. And it's also very important for so that's external people. It's also very important for internal management purposes. So you know how much money you're spending, how much do you think you might need in the future as well. This course is based on my Udemy course. So the recordings are from Udemy, and I think I'll make a start now. Hello and welcome to this course on financial forecasting and modeling. My name is Osman De Silva and I'm the founder of Tech Citizen Entrepreneurship Academy based in London. Section 1, Course Introduction. The main objectives of this course are: A, understand principles of the model. This is the starting point. You need to understand the key concepts about the model and its relevance to your business. B, develop the model in your own business. Next, you must apply the concepts in order to develop the model in your own business. C, use the model for investment and management purposes. After the model has been completed, then you need to start using it in your business. This can be for several reasons, such as seeking investment and as a management tool. Who is this course for? This course is for entrepreneurs, that is, people that have an existing business, startup founders, people who are about to start a business, and professional and potential entrants. This is for professionals in full-time employment, but who are in the process of starting their own business. Who is Osman De Silva? About myself, I am an experienced mentor and business coach at Tech Citizen Entrepreneurship Academy in London, which has over 7,000 members. My mentors and myself work with entrepreneurs, startups and scale-ups to get them to the next level. We hosted over 500 talks, seminars and workshops over the past 7 years. Our USP is always to produce quality business content, and our mentors each have 30+ years of experience in their field of expertise. Over the years, I have worked in many different organizations of all shapes and sizes. From this, I have obtained knowledge of industry best practice, and I get to see the things that work and a lot that does not. What is forecasting and modeling? It is the estimate or forecast of A, the income, and B, the expenditure of a company for a future period of time. This means you will need to investigate both the revenues and the costs of your company. The investor will want to know your forecast for the next 5 years. Also, this is based on estimates of what you think things will be like in the future. For an established business, this is an easier task as they have many years of historic data to give them guidance. For a startup, this is more challenging as they do not have access to any historic data. How is this useful? The forecasting process provides the means for a business to express its goals and priorities and to ensure they are internally consistent. It also assists the firm in identifying the assets and resources requirements, and finally, the needs and timing for funding and investment. So the objective is we are trying to create a model of the future, and usually for startup or a new business, they will not have that information because they don't have historic data. A lot of people use historic data to predict what goes on in the future, but as you see, it's not always that easy. For example, no one could have predicted what's going on from March of this year, the events. No one in the world could have predicted that. So you just do your best in predicting the future. And usually we want to see, we call it financial model, but really it's two models. One is your income and the other is the expenditure model. So they're two different models. Why is it important? Smart startups don't wait to set up accounting systems. They use the information available to them immediately and they act on the information. A study shows that those with early financial monitoring systems grow faster in revenues and headcounts. These firms are more successful and have a higher valuation. Who is responsible? Who is it for? The person responsible is the finance or funding officer. It is for all stakeholders in the company. Do not delegate this to a third party, such as consultants or accountants. Make sure that all of this summary is produced in-house. Section 2, Core Concepts. When is it done? Start well before you spend any money in the business. You do not need actual or historic data in order to do a forecast. Do not wait for income or revenues before you start. Review the model regularly, ideally every 3 months. Why do you forecast? To plan for the future, it is a planning exercise and tool. For management and control, to improve business management and control, it is a tool for business. Milestones and metrics, it aids you in achieving your milestones and metrics. Accountability makes you accountable
to your stakeholders. Fundraising helps explain the requirements for additional funds, specifically what you require and when, to identify the periods and times of surplus and of deficits. There will be months when you have a surplus or excess of funds, and when you have a shortfall or a shortage of funds. New ventures validates the financial viability of a new business venture. That is, allowing you to create a model that proves how the business might gain significantly if certain strategies, actions, and plans are performed.
As the previous slide said, you cannot just do it a 12-month forecast in the future and just leave it. You've got to be checking it every 3 months and keeping a backup of your original copy. So you're constantly trying to readjust in the short term for you to obtain your long-term objectives. That's what you're trying to do. So it needs constant change and feedback. It's not something you just do and leave.
How is it done? You will need to list and analyze the company's income, for example, revenue from products and services. This information can be obtained from market research, competitors, and by interviewing potential customers. Expenditure, for example, rents, rates, salaries. This information can be obtained from business suppliers and recruitment websites. Finally, one-off costs, legal and research. Make sure you know the one-off costs that are relevant to your business and industry.
You'll soon see here that you need to have a complete listing of all the costs or potential costs that you're going to incur in a business. Surprisingly, a lot of companies, for example, if you're tech, will have very similar costs. Like you might need an office, you might need coders, you might need an accountant, you might need designers and stuff like that. But there could be other costs that could be unique to your business, because there's so many different types of business. There's B2B, B2C, some could be selling online, some could be selling products, some could be selling services. So there could be aspects that are very unique to your business, and you should know the expenses or costs that you will incur in the future.
Assumptions. You need to make reasonable assumptions that can be justified. This is also important for the investor's understanding of your financial model. You must have good backup from more than one source. For example, if you need a graphic designer, then find the salary from 3 different sources. Precision is not required because the future cannot be predicted accurately. Things will not turn out to plan. However, the planning process is important. That is, do not work to decimal places in your figures. Be as specific as possible with your assumptions. Some examples of assumptions are: sales will increase by 15% in the next financial year. We need more than one admin staff in 4 months' time.
All the figures involved will be based on assumptions that you have to make, and all the assumptions will need some form of backup. So for example, if you say, we're going to get an office in 3 months, and it's going to be whatever, £2,000 a month rent, you'll need to at least show that you've done some research and that you've got maybe 3 or 4 invoices to indicate that. Or for example, good classic example is if you need a CTO or some programmer, you would have done some research and you know exactly what their salary is going to be. Yeah. Because you cannot just put in figures there, even if it's a pound, 10 pounds, 100 pounds, 1,000 pounds in your spreadsheet without having backup. The investor, or even in your company, you might have staff who challenge you and say, look, how do you know it's going to be this? So always, everything, every figure, the bottom line is the assumptions. You must have assumptions to prove it.
Types of models. Better to have 3 models for different scenarios or outcomes. A, expected, that is, what would be normal. B, best case outcome, that is, most things are going well. And C, worst case scenario, that is, sales decline and or cost go up. Financial modeling is the task of building an abstract representation or a model of a real-world financial situation. Financial modeling is largely synonymous with financial statement forecasting. This usually involves the preparation of detailed company-specific models used for decision-making purposes and for financial analysis. Section 3, Everyday Example. Income and expenditure weekly spend. Here is a simple everyday example. You do use forecasting on a regular basis without realizing it. A reflection of how much will be spent, how it will be spent, and the period of time it covers. Everyday examples of personal budgeting, covering a 1-month period. Expenses, food, travel, utility, rent rates, entertainment, fashion, and clothing. Example, how to spend £1,460 on weekly essentials over a 4-week period. There are a few things to note here. The rent is a fixed amount each week, which is referred to as a fixed cost. Fashion spending is twice a month. Entertainment is a small spending item, and for that reason is kept at the bottom. There is also scope to spend money on one-off items such as removals, storage, or key replacements. Recurring costs such as mobile phones or subscriptions. Seasonal cost such as heating and gardening.
What I want to show you with this is that people would generally have an idea of how to, budget with their own monthly income. So they do have an idea of what a budget is. But when you're doing it at professional level, you have to really understand what you're doing, because if you watch Dragon's Den or the American Shark Tank, you find that usually what happens is most of the entrepreneurs cannot even answer very basic questions about their business. When it comes to financial information, they usually can answer other questions, but when it comes to finance, they cannot seem to answer very basic questions. And in fact, they could even end up losing the chance of getting any income. The point I want to try and make here is, we are looking at very small figures in the spreadsheet here of your rent and food and whatever. But when you come to do a spreadsheet, we're talking of £100,000 of money, how you're going to allocate over 6 months. You've got to be able to know the amount you're putting in, exactly where you're putting it in, why, how, when. You'll be challenged on all these assumptions and figures that the investor will ask you questions on. So you've got to know, for example, if you're going to get an employee, is it going to start in month 5? If you start from January to December, 12-month a spreadsheet, is the employee going to start in month 5? You have to know which expenses are regular, coming in every month, which are random, which are one-off, which is for your business. You've got to understand that extremely well.
Income and expenditure totals summary. Think of this as your bank account that you check each week. Each week you will have 4 items. A, expenditure. In this example, take the total weekly expenditure from the previous PowerPoint slide. B, total income. Say that there is a salary receipt in week 4 of £2,000. C, an opening balance. This is the opening balance at the start of week 1, which is for £1,000. Closing balance. This is the closing balance at the end of week 4. Important points to note. A, the closing balance of 1 week becomes the opening balance of the next week. For example, 625 is the closing balance of week 1 and it becomes the opening balance of week 2. The closing balance of each week tells us if we have a surplus or deficit situation. For example, at the end of week 3, we have minus 135, which is a negative amount and represents a shortfall in funds.
Right. Usually you'd have these not in weeks, but for your business in months, and you could be projecting 1 year or 18 months. You usually would have an opening balance and closing balance at the end of each month. The closing balance of 1 month becomes the opening balance of the next month. In this example, I'm simply bringing the expenditure from the previous slide. And the important thing is, well, there's several important things here. At the end of every month, you know whether you're in surplus or in deficit. For example, the minus 135 is showing you that in week 3, at the end of week 3, you will be in deficit. And you also know how things are going to be at the start of the month, because the end of the previous month will be the opening balance of the new month. So if you can predict in future that you're going to have a huge deficit, maybe the sales are low, or you have a huge unexpected expenditure, then you can plan accordingly, at least if you have this model.
Section 4, Income Projection. Money can come into a company from a few sources only. A, sales. Better to have several revenue streams. The quality of the customers is important. B, investment by equity or debt. The fewer investors, the better. Smart investors are always preferred. Loans from banks or credit cards. D, other sources such as joint venture, partnerships, sponsorships, royalties, grants, and other forms of asset-based lending.
As I told you at the beginning, you really need 2 models. One is your income model and one is your expenditure model. They both have a lot of things you need to be careful about, because you will get challenged by the bank, by the investors, by the VCs. One of the tricky ones is the income model, because anyone can say, look, next year we'll make £1 million or £10 million, and by the end of year 5, our revenue will be $50 million or $100 million. But most companies, most startups and most companies are unable to back it up. Now, I get the question that's asked quite often is, if we are a startup and we don't have much information, how can we predict our income like 2 years ahead or 3 years ahead? There's several ways of doing that. One is possibly looking at the competition, which are a few years ahead of you. And the other is even doing some research, and you're able to prove how the industry you are in is going to move in several years. Maybe Stuart, you can, because you're more experienced, if a VC or someone had to ask you in 2 or 3 years, how would you predict your income? Could you just write in the chat box how you would, give us some ideas, because other people would like to hear from you, how you would predict your income in 2-3 years with a detailed, where would you get that information from? That'd be great. Stuart Easton, if you can help me.
Can you hear me?
Yes, go on.
Yeah. So, I mean, the way I've done this in the past is really focusing on, what do I know? What do I not know? So if I can prove anything, right? So you might know how many customers there are out there, and you might know or be able to estimate the revenue per customer. And then so you can make an assumption about that. But the key thing is that, in my experience, what investors always want to know is, where does that number come from? Right? So if you say we're going to win 10 customers, you've got to be able to explain that, that means that you've had 100 leads, and I'm going to generate 100 leads from the web or from my personal network or from LinkedIn or whatever it is. And you always want to have just a little bit of evidence that that's credible, because otherwise it's just fiction. And this, you're spot on that this is the number that investors really look at to see, are you being sensible? And if you underestimate, they're going to look at your company and say, oh, gee, these guys aren't very ambitious and they're not going to grow very fast, so I'm not going to make money.
Oh dear.
If you overestimate, they're going to look at you and go, you're smoking dope, guys, you're idiots. Right, so this is the hardest thing to do in the whole thing.
And can you give some advice on how you would predict, like way ahead, like 1 year ahead or 2 years ahead? How would you do that?
Yeah, so I mean, when I'm doing it, I tend to just sit down and say, right, what do I know? And I'll write down. Earlier on you said about writing down assumptions. I usually start with those assumptions. What do I know? So I might know a market size. And as I say, have a guess at or whatever evidence you have for how big a deal is, and then I'll literally just start with right, how many leads do I think I can generate? What percentage of those will convert? And then what percentage of those will give me, so sometimes depending on what I'm doing, maybe I'll break them up into big deals, small deals, big deals, medium, small deals. And have some kind of distribution to that. And what you're doing with that is you're showing you're working out, you're showing your assumptions. And so the VC's seeing from that actually you're thinking about it. You're not just making numbers up. You're sort of thinking about it, and you're challenging your own assumptions all the time to see if those are real. And then it's just like you had earlier with the cash flow chart. You just go, basically as you're going, you can kind of assume a certain growth rate, and again you make that assumption visible, and so just month on month you say, great, I think I can generate this many leads that convert into that many opportunities that convert into this many sales at this price, and you just every month or every quarter you kind of incrementally increase that. And again, what people are going to be looking for is, do you just assume that your sales will grow forever without any constraints, or are you actually being sensible about the fact that, when you reach a certain point, you need to hire a sales guy, and it's going to take that salesperson 3 months to 6 months before they become productive. So it's not just the sales line that matters. It's how are you going to deliver it? What resources do you need to deliver it? And when do those costs start? And what the VC is not going to believe your model, right? Let's get that out of the way. They're not going to believe your model.
Yeah.
But what they're looking for is how you've approached it. They want to see if you're being sensible, if you understand where the risks are, if you understand how all the pieces fit together. And we actually had one investor invest in us simply because we'd gone to the trouble of, in our assumptions, we'd assumed a certain amount of web traffic. And so we'd gone to the trouble of spending a couple of months just trying to generate web traffic to prove that we could do that, right? And so we could defend that part of the model. And they kind of went, well, that was really cool. We don't usually see people doing that. So do you know what? I'm going to take a punt, have some money, right? Sometimes it's as simple as that, having, just one piece of evidence to back up, each of your assumptions is going to get you somewhere. But don't go in there just with a hockey stick shaped revenue line that's got no justification, because you will get thrown out very, very quickly.
Also, Stuart, because you're B2B, it's much different from B2C, right? The sales.
Yes, but I think the approach is the same, in that you've got to show you're working out. So if you say we're going to sell 100 units in month one, well, how are you going to sell? Are they going to be coming from web sales, or are they going to be coming from people banging on doors? And then if you suddenly have a jump in sales in month 9, you got to make it really clear that's because in month 9 we expect John Lewis or Tesco's to take our product, and we've already spoken to them, and this is the feedback we've got, right? The more evidence like that you can build, it doesn't really matter if you're consumer or B2B. What matters is that when you put that revenue line in, that you can justify it, right? You've got the maths, you've got the assumptions, and wherever possible, you've got evidence to back up your model. It's your thinking that they're assessing. It's not the number you come up with, because that number, everybody knows that number is fiction, right? But what they're looking for is how well do you understand your model?
The other point, Stuart, everyone, because you're more experienced, everyone's going to ask you that, look, now we're in a very bad situation and this could continue for another 12 months. How am I going to impress an investor when things are going so badly?
That's an interesting one, and I think because I've been talking to a few other sort of early growth stage companies, because we're all having the same discussion about raising, not angel money but Series A or beyond. And I think the answer is if you've got a track record, and you've got some good investors, then a lot of investors are follow-on investing, right? So if you already have some money, if you look at the numbers out of the States, for example, the investment numbers recently have been really quite healthy, but most of it has been in follow-on investment rounds. So I think
you mean late stage, yeah.
Yeah, or even just following on from angel. You might just decide to do some kind of in between, not quite a Series A, but not quite an angel round or something like that. I think what investors are looking for right now is people that they're looking to make investments that are less risky than normal, because the environment is insane. And so, one of the techniques that I know a few people are following is to look at almost trying to raise raise less than they would normally try and raise, to de-risk it, to almost make it a little step to say, great, let's phase this investment so that we can, get through this period of great uncertainty. I mean, it's incredible uncertainty out there. So, anything that you can do to de-risk that is great. And anything that you can do, I mean, the general rule, regardless of COVID, is the more you can achieve before sitting down with investors, the more you've de-risked it, and the more likely you are to get money.
The other point, Stuart, I mentioned is using information from your competitors. Do you use that to sort of predict out income? Use that?
Yeah, yeah. I mean, yes, that's a really good. Not so much to predict income, but to validate your assumptions. So we've gotten us. So when we were raising our angel round, one of our competitors had just raised a Series A of about $12 million or something.
Wow.
and we'd managed to winkle out an estimated revenue number from a disgruntled employee of theirs. So we were able to say, go to the investors and say, right, this company has done it. This is their model. This is how we're different. So there is a market, because Levent, you kind of said there about market size and then figure out how much of that market you can get. So the first step there is there a market? Will anybody pay for this service? So if you've got a competitor there, that's a really good thing from the point of view of being able to validate that, yes, there is a market, put a check in that box. So that's great. Investors now know there is a market, and the question goes on to, can you win in that market?
Okay. This is a good question also, Stuart. Olivia's asked how to go about getting angel investment in the current environment. It's a tough one.
It is a tough one. It is a tough one. But I think, so going back to what I said earlier, I think from what I've been seeing, I think there are more follow-on investments than there are initial investments. So that makes it harder. I mean, getting investment from angels is hard anyway. You just got to get out there, pound the streets, network like crazy, leverage people, go present again, listen to feedback, tweak things, just keep going, be tenacious, you'll get there. And I think that applies in COVID times and not in COVID times. What's different now, I think, is they're a little bit more risk averse. So you're going to have to work a little bit harder to convince them that the risk is managed, right? So those assumptions and things and the proof points that you can get, you're going to need more of them. And then, of course, you've got the whole challenge of not being able to meet face to face. And an awful lot of angel investment is just, do I believe in this person? And that's really hard. So anything you can do early on to alleviate that, right? So maybe make yourself a nice little video with your team where you kind of talk a little bit about who you are. Anything that you can do to kind of build relationship and establish credibility, I think can help at any time, but especially so now when you can't physically get together with those investors so easily.
Okay, thanks, Stuart. Olivia, with the angels, the thing is, angels do not actually go out and put their information on a website like the VCs do. VCs have to put everything out in the public eye. So you might need to do some research to try and find the angel, and in particular, see if they have invested in something very similar to yours, because they'll have a passion for that industry. Usually angels invest if they have a passion for something. So for example, if an angel has a passion for education, they'll invest a lot of money in that. So it's more about doing research, but angels do not publicize themselves. And as Stuart said, a lot of networking as well. To answer Levant's question very quickly, there is something called, you'll see VCs talk of something called bottom up and bottom down. What Stuart was talking up, which is the right thing, which is actually going bottom up, where you say, look, I have one customer and he'll pay me £100, and times 10, I'll get $1 million, whatever. What you do not want to say is bottoms up, where you say, look, we can take 1% of this entire market in 2 years. I mean, that's, that doesn't make any sense. So you have to work your figures and assumption from the bottom up. Anyway, let's go on.
Income, revenue streams, and sales. You need to have two sets of information. A, the number of units sold. This can be obtained from competitors, historic actuals, and trends. And B, Price per unit. This can be obtained by market research and by asking potential customers. It is always good to have a breakdown of your different revenue streams. That is, the different types of sources of income. You must have a tested pricing model. For example, dollars per product sold, dollars per hour for a service, freemium, subscription or SaaS, which stands for software as a service. Revenue model. Sales price. Will customers want to buy at this price? Sensitivity. What is the highest and the lowest price? Sales performance. When will the venture generate revenue? How rapidly will the revenue grow? Sales funnel. This is a representation of a sales funnel for a company. There are many potential customers at the top of the funnel, but few will move all the way down to become actual customers. Eventually, few will decide to buy your product or service. There are several stages that will take place as a person moves down the funnel, from a potential customer who is a cold lead to a hot one. Also, after you have converted a customer, then you must be able to retain them. How to project revenues. Research-based forecast from market research reports. Historical forecasting. Using historic figures, data, and trends to predict future growth. For example, last year's revenue plus 5%. Consider external factors, economic, political, demographic, trends, behaviors. Are population changes affecting service demands and/or revenues? Section 5, Expense Projection. Expenditure and costs. What are the cost drivers of your company? A. Fixed costs and overheads. These are costs you will need to pay on a regular or monthly basis, irrespective of your activity in the business. For example, if you go on holiday for a few weeks, or if your sales are down. You commit to paying these costs in advance and for a fixed period of time. These costs are usually for the high spend items in your business. For example, rent, rate, staff costs, contractors, consultants, product development. B. Variable costs or direct costs. These costs are related directly to your output. So the more items you produce, the more these costs increase, and vice versa. For example, web hosting, distribution, packaging, raw materials. The good example is of a coffee roastery selling ground coffee to customers. The variable cost will be the coffee, beans, packaging, and distribution cost. C. Administration, general, and operational expenditure. These costs mainly relate to the running of the business. All types of businesses will incur these costs on a daily basis. For example, sales, marketing could include trade shows, flyers, advertising, utility costs, gas and heating bills, phone, internet, insurance, bank credit charges and interest, office supplies, stationery, professional fees to lawyers and accountants. One-off costs. For example, special projects or market research. Say you would like to start selling in a new city and you ask a consultancy to produce a market research report for you. D, miscellaneous or sundry cost. These are small costs that cannot be put under any expense heading, so you group them together as sundry items. For example, fines or penalties. Balance sheet items. What is the capital expenditure of your company? These items or assets are placed in the balance sheet only. Fixed assets. They include computers, fixtures and fittings, for example, furniture and CCTV, heavy equipment for the trade, owned property and buildings and land, kitchen and laundry equipment.
At this stage, do not get too concerned about the balance sheet items.
Staff costs. This big cost will need to be considered carefully. It will include the owner's or founder's salary, the management team, the directors, the employees, the contractors and outsourcing. Also stock options. You will need to seek legal advice. Put each staff under their departments, for example, sales and marketing, finance, IT, and HR. Capital and resource efficiency. How to make the best use of your limited resources. Some examples. Make sure to include all costs in your forecast. Outsource. Use contractors or temporary staff. Rent or lease rather than buy. Also make good use of comparison sites for benchmarking with other industry sectors. Please follow this link below.
Couple of things. Firstly, in terms of your expenditure, I told you people have joined us that you need two models. One is for the income and one is for the expenditure. For the expenditure, the one you're going to be challenged on the most is the staff cost, because that is going to be the biggest cost you're going to have. A lot of startups and scale-ups, the second biggest is usually the rent if you have office accommodation. But most startups and scale-ups, they work from home or they're remote. So the key thing is they're going to ask you about the staff cost. Why do you need staff? When do you need them? How do you need them? What job going to do? Are they going to fit into your team well? Stuff like that. The other thing is, I talk about comparing to competitors, and I've mentioned good sites for benchmarking and stuff like that. You have to compare apples with apples, because if you're a startup, there's no point in comparing yourself with existing business been around for 10 years or 15 years. Always compare yourself to companies maybe in the same country, or for example in the European Union, but who are just few years ahead of you. It's critical you understand that, right? No point in comparing yourself to an Amazon or to Facebook or anything like that.
Section 6. Technical Aspects 1. Stages of a company. Most companies will go through 3 stages, and each stage will last for around 3 years. So you could say that it takes 10 years plus for a company to fully develop to maturity. Stage A, pre-seed or idea, involves product development, testing, validation, and IP. You will have a small team, a CEO, CTO, a technical officer, and COO, which is an operations officer. B, seed stage. You will have product launch, MVP or minimum viable product, a medium-sized team with sales and business development, marketing, spend, and some small revenues. Finally, the third stage, which is post-seed or growth stage, you'll have a larger team with strategy, project management. You'll have a marketing and PR department, and you'll have multiple revenue streams. Types of investors. There are several types of investors, and their investments relate to the stage of the business. So at the early stage of the business, you usually have investors who have family and friends and the bank. At the mid stage or middle stage of a business, you get angel investors and venture capitalists. At the late stage or final stages of a business, where the company is extremely large and growing and profitable, you would get private equity and listings on the stock exchange. Profit making and loss reduction. A business exists to make a profit. Profit is defined as income less expenses. Ideally, you want profit to be as high as possible. To increase the profit, you need to A. Increase sales or revenue, B. Decrease costs, or C. Use a mix of the above. Break-even point. The three stages of business profitability are A. Firstly, the loss-making stage. In the early stages, the cost and expenditure exceeds the revenues. B. The break-even stage. This is the point at which the revenues equals the cost, so there is no profit or no loss. Finally, the profit-making stage. In the later stages, the revenue exceeds the cost.
The concept, you've got to understand that, especially for startup or the business is just kicking off, that you'll have to go through various stages of the company. And we've simplified it saying that initially be a loss making, could be a year, could be a bit longer. Then you tip over and you start getting some revenue. That becomes your break-even point before you start getting revenue. And then you end up, eventually the loss starts getting smaller and smaller, and then you start becoming profitable. So make sure you understand that you are moving from a loss. Usually most companies, again, I'm generalizing, that you move from a loss to a break-even, and then smaller losses and the profit starts increasing, and then you start becoming profitable, hopefully in the future. And that's again something that the investor likes to see.
B2B and B2C. You can have two types of business categories. Firstly, the business to business, B2B. This business will have fewer customers but high sales per customer. So, relatively few products sold. Also, there will be longer sales cycle. For example, a business that produces HR and accounting software, and they try to sell it to other businesses. B2C, business to customer. This will have large number of customers, but small sales per customer. So there will be many products sold. Therefore, this model requires a large marketing budget. For example, supermarkets and FMCG, fast-moving consumer goods. Assumptions. You need to keep documentation of the assumptions and provide relevant explanation for each assumption. 1. Decide on expenditure. How much to spend, when to spend, where to spend, why do you need to spend. Contingency. It's usually good to leave a contingency of about 10% for unexpected events. Decide on sales projections. How much will be received? When will it be received? From where will it be received? Why will it be received? Section 7, Technical Aspects 2. Scenario planning. Asking the questions, what if? Scenario planning takes into account the uncertainty involved in the planning process. For example, you can do what-if analysis to build 2 or more forecasts that each assume a certain level of revenue. Or you could specify a result that you want a formula to produce, that is the outputs, and then determine what set of values will produce that result, i.e. the inputs. Each scenario will consider a set of possible future events. Internal events to consider, for example, staff costs, premises, office, rent increases, sales growth. External events, many of these will be out of your control. Customers, suppliers, investors, stock, inventory, country risk, distribution. Recommendations. Good idea to build 3 scenario cases. A, the best case or the optimist scenario. That, for example, you could say there's an increase in sales for the next year. The normal case, which is realist, assumes that things are going to happen as planned or within expected range. The worst case, pessimist, things can go wrong. For example, costs could go up or we could lose a key account or customer.
A few points here. I can see in the chat box Stuart mentioned about finding investors. One thing about, there are a few angel groups. For example, in London, there's Angel Den. They charge a lot of money just for you to pitch in front of a group of the investors. Before you get investment, they'll charge an upfront fee. I would suggest not to do any of them. This is my personal opinion. If any investor is charging you money to pitch, like £1,000 or that sort of thing, and Stuart says, avoid anything crazy like that. And also, they will not give you a guarantee that you'll get investment. So that is a complete waste of time. The other thing in the slides I've suggested is that you have 3 case scenarios, best case, worst case, and the normal case. You only have to give one thing to the investor, which is just your normal case. But you keep the other cases for your internal management accounting use. Basically, you can keep as many for your internal use, keep as many different models as you can, different scenario plannings. But for the investor, you only give them one, which is just the normal case. And you only ask for one lump sum of money when you go to an investor.
Milestones achieved. Match sales and operating expenses to key milestones by having deliverables and deadlines. Milestones are a function of time, cost, and productivity efficiency. Burn rate versus runway. Burn rate. This is your monthly expenditure on average. Runway. The period over which you have sufficient finance reserves or funds to keep you going. That is until you run out of cash. What happens when a business grows? Income increases. You must improve and increase your customer services and sales support. Direct expenses or cost of goods sold, COGS, can decrease due to economies of scale. For example, a coffee roastery buying in lots of coffee beans as the customer base increases. COGS, cost of goods sold, will be explained in the next session. Operating expense increase. Examples: more staff cost, rental space, increase in stationery.
Okay, I think this is a good point to end the seminar. I'll be around for about 15-20 minutes. You all can post questions if you want in the chat. As I mentioned, this is part of a Udemy course, and it has, there's a bit more information, and it also has, I don't know whether you can see, I've done a complete template with various assumptions and stuff like that. So you just have to plug in the figures for this thing. If you want, you can, I'm giving you all a special discount for anyone who's for around $9.99, under $10. And I'll email everyone if you want, you know, the entire spreadsheet, the entire course. I'll give this Udemy course to Stuart, of course, for free. Stuart, can you just drop your email contact details? I'll give you this course for free. I'll hang around for any more questions if you all have things. If it's very, very detailed, you all can email me by joining the course. But if you'll have any generic questions, yeah, thanks, Stuart. How can you get all of these spreadsheets? Well, again, as I said, I'll email everyone the special discount of under $10. And all you do, it's a very good thing because it's got everything you need, absolutely everything you need in there. And you just have to go in and plug in and put in your own figures. And just write over my one. And that's it. It gives you the entire thing. Because my background, I'm sort of an accountant. I'm an accountant and an engineer, so I put that together. Is there any more questions you all have? I'll send everyone an email with the replay of this entire video seminar, as well as with the Udemy discount as well. If you want, please put in information about yourselves, your email, your company name, so other people on this seminar can contact you. Just put that information in the Zoom chat box. Your LinkedIn profile, your name, your company name. Right. When investors are taking decisions, what is the main point they focus on? Marketing, total budget, risk, etc. That's a question by Levant. Very good thing. The key thing is, of course, they're going to look at the very big expenditure, which I told you is going to be the staff cost. And of course, if you have office rent, that's going to be the next expenditure. They're going to challenge you on that a lot. And also, Stuart mentioned that if you show, looking at the income side, that if you show your income is going like jumping up very high like a hockey stick, they're going to challenge you on everything. Those are the two main areas, either very high expenditure or very high sales. They're going to challenge you on that. Sorry, this is for the whole group. I'm just saying if anyone has any more questions. Right. Stuart asked me to talk about sensitivity analysis. This is a very good thing. Scenario, it's called scenario planning. I'll talk for a couple of minutes on this. Very, very important. Scenario planning or sensitivity analysis. Basically, as I told you, you're looking for you have a normal case and then the worst case and the best case scenario. Of course, the best case means you say your sales are going to be very high, your expenses are very much under control. The worst case is your sales are very low, and for some reason you need a lot of expenditure. Maybe you need to get a lot of very expensive technical staff in. You need to create these scenarios, but with the investor, you only need to give the investor one thing, which is your normal, the normal thing. You do not need to confuse the investor giving them many scenarios, but it just prepares you internally that if you're challenged, for example, we already mentioned with Stuart that, how do you prepare for this case where we could be in lockdown for 12 months? That is like the worst case scenario, which is completely unexpected, completely out of the blue. This is planning for worst case scenario, right? Hopefully in 2 years, when things improve, you might get into a better case scenario. Yes, we didn't have time to cover everything on this 1 hour seminar. The important thing is also, people have mentioned, I think a couple of you all have mentioned about the risk. You have to write down what the potential risks of your business are. The investor might not know everything. There could be several things. For example, there could be delays. As I mentioned, the other risk could be that you need a very high-tech, qualified, AI expert, artificial intelligence expert. That could be another risk, and you might not necessarily get them. So you need to list the risks in your business, which is very unique to your business, and find ways how you can de-risk the business or mitigate the risk as well. That shows the investor you're thinking very carefully. I'll stay for another 5 minutes if you have any more questions. Thanks, Stuart. Hope all is well, and please keep safe as well. Right, I'll log off now. I think because, okay, sorry, Lavont has asked, for a business that is already in the market, which way is better, to find an angel investor or to find a strategic investor partner? Right, good question. Money is money. It doesn't matter really where it's coming from, but the key thing about the investor is you need to find if you can find a smart investor, it's even better. So if you can get that, that's great, as well as if you can get a strategic investing partner that's even great. So what I'm saying is, if you can get both of them, that's great, but make sure that your investor, your angel, is a smart one. So forget one or the other. It's better to get both if you can, because that'll help your company to move forward even further. I hope that answers your question, Levant. Right. If there are no more questions, I'll close the seminar down. And thanks very much, everyone. I'll be in touch via email.